When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you the straight talk and honest insight you need to help you achieve your financial goals through smart investing and careful planning. My name is Jeff Shade, and I'm just here to ask the questions. But the words of wisdom and solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing today, Dave?
Doing great. Sure good to be back together.
Always glad to be with you here too, Dave. I mean, we're doing a podcast, and so many people are listening to podcasts these days because they can consume them on their own time. And now we've done so many podcasts that people have a chance to binge on Retire Your Way if they want to. And of course, all those podcasts are found online here or wherever great podcasts are listened to. Well, Dave, I want to talk about the stock market today. So many people worried about the market. It's been up, it's been down, it's zigzagged. I mean, I'm getting dizzy from the ups and downs of the stock market, sort of like a roller coaster. So the title of today's podcast is going to be The Stock Market is Near Correction Levels. What if I told you the fastest stock market recovery in history is just a misunderstanding? Well, you've all probably seen headlines like this one: the stock market hasn't seen a 100-day gain this strong since 1933. Or how about this one: the U.S. stocks hit record highs, ending the shortest bear market in history. Well, today we're going to dig into exactly what's going on in the stock market and what we can learn from it. So, Dave, doesn't it seem that the stock market is blazing past record highs while the economy is in free fall? And at the same time, a record 50 million Americans are sitting around without a job.
It should seem off, but here's what's interesting. The fuss about the stock market and how well it's doing and the disconnect, all of this incongruency comes down to one thing: a misinterpreted term. What all these headlines refer to when they say the market's up, the stock market's doing well, the market's blazing forward, all of these headlines refer to an index that no longer, in my opinion, directly reflects the true stock market. Most stocks, for example, have a long way to recover from the crash that we saw in March and April. And this puts a lot of confusion in front of investors who are basically looking at the news and see a soundbite and assume what they hear on the news, it's what's happening to the entire stock market or what's happening to their portfolios. And they can be at more risk now than they're realizing because of this misunderstanding.
So, Dave, we've heard about the market and we've heard about the stock market, we've heard about the economy, and I think that people get those confused. So, after all, what is exactly the stock market?
Yeah, sure. So we hear words like the stock market or stocks in the media. They're really not referring to every single stock in America. What they're usually referring to is a term that most have heard of. It's the S&P 500 or the S&P 500 index. Now, the S&P 500 index, let's talk about what exactly that is. It's an index that tracks the performance of America's top roughly 505 biggest companies. Now, what's interesting is that index really only contains about 75% of all American stocks, but it's considered really the key gauge to how the overall U.S. stock market's doing. So this term has become so prevalent that it has become synonymous for the entire stock market. What I mean with that is when you turn the news on, you hear people say the S&P is up 5% or the S&P is down 2%. Most folks, without even knowing it at a subconscious level, hear that and they just assume that means the entire U.S. market is up that much or the entire U.S. market is down that much, or more importantly, it means their portfolio should be up that much or their portfolio should be down that much.
So what this means is, as you said, the S&P 500, that's 500 of America's stocks, but that's only about 75%, and everyone may not be invested in those 500 stocks. So, Dave, let's take a quick look at how the index arrives at this figure that we see in the headlines.
Sure. So in short, the S&P 500 index, what it does is it calculates the performance of all of these 505 stocks. Now that's simpler than it sounds. All it means is that they look at an individual stock and they'll say, oh, that stock over the period we're discussing is up 5%. Well, then they'll look at another stock and see what over that same period, how much it's up or down. So you would think that they would just add those up or subtract them if they're negatives and come to a number or an average up or down for the 500 stocks. But it's not as simple as adding them up and dividing by 505. Each stock in the S&P 500, Jeff, carries a weight, and the weight is based on the company's size or its market capitalization. That's how big the company is. So the more weight, in our industry, we would say the heavier the stock, the more weight, the more of its performance affects the index. So let me give you a concrete example. Apple stock has a market cap of 1.7 trillion. That's basically what they assuming it's worth based on the number of shares outstanding and the price per share. 1.7 trillion. That's roughly 5 times higher than Visa stock, which has a market capitalization of 0.325 trillion. So basically what that means is that when Apple stock goes up, it affects the S&P roughly 5 times more than when Visa goes up. The formula is supposed to give us an accurate picture, Jeff, of how America's entire stock market is doing. The problem is that may or may not have been what it did in the past, but it doesn't work that way today.
So what you're saying is that the larger the market cap, the heavier the weight, and as you said, Apple is at the top there, Visa is somewhere in the middle. That's interesting, Dave. I never knew that. So are you saying that the S&P 500 no longer represents the stock market?
Yeah, I would say it's certainly worth taking a look at and making a decision when you're looking at the S&P. The 505 stocks in the index come from a range of sectors, and what I mean by that is some are from consumer goods, like things like you would think Walmart, for example. Some of them are technology, like Apple. Some of them are from financial. That could be something like Wells Fargo or Bank of America. So we've got these major, and energy is another one, but you've got these 9 predominant sectors of the U.S. economy, and the 505 stocks are spread out over those 9 sectors. They used to be pretty evenly spread out based on the size of the sector with respect to the U.S. economy. But that's really no longer the case. During the pandemic, as investors, Jeff, have flocked to the tech industry in droves because of this weighted issue and how the S&P is calculated. Tech stocks have literally hijacked the S&P big time.
So Dave, hijack's a pretty strong word there. What do you mean by hijack the S&P?
Well, let's take a look at an example. The tech companies, or the tech sector that's represented in the S&P 500, make up right now more than 27.5%, so over 25% of the S&P 500 index. If you add Google and Amazon to that and Netflix, it adds up to 36.6% of the S&P 500. So that is the highest share of tech industry stocks in the S&P ever. Even if you go back to 2000 and during the dot-com craze, the tech stock didn't dominate the S&P to the level that it does now.
So Dave, is the tech sector the force that's driving the entire S&P 500?
Yeah, right now it is. This year, the S&P, as we know, after the correction, is up over 50% from its lows in April, right? Blazing past a record before COVID. Right? Now, this is, in my opinion, this is giving investors the wrong impression that the entire stock market is booming. The reality is most of the growth in the S&P 500 is driven by the tech stocks. So 7 out of 10 of the S&P 500 top performers this year are tech stocks, 7 in 10. Now, to contrast that, 63% of the stocks in the S&P 500 in the index are down. That's according to CNBC. And because the tech stocks are disproportionately higher weight than the rest of the stocks in the index, the fact that they're up disproportionately raises the S&P 500 if you're thinking that it's an even, fair, and balanced description of how every sector in the U.S. is doing.
So the disproportionate weighting of these large tech stocks combined with their massive moves over the last 4 months is how tech stocks grew into the ballistic force, pushing the entire S&P 500 to a historic record. Is that what you're saying, Dave?
Yeah, that's exactly what I'm saying. And I'm also saying that the S&P reaching all-time highs does not mean that the entire stock market is doing well. And to continue that idea, it doesn't mean that your retirement account, because you're invested in equities and in stocks, even if you're all in U.S. stocks, it doesn't mean that your retirement account is hitting all-time highs or even doing as well as the S&P.
So, Dave, can you give us a concrete example of what you're talking about here?
Yeah, okay, so let's take a look at how the S&P would look today if we took out the tech industry, that has Facebook, and if we took out Google and Netflix in the tech sector. Right now, as of the recording of this, right now the S&P for the year is up roughly 2.2%. So it's retained all the losses in April and May, and we're up a little bit. If you got rid of the tech industry and Facebook and Google and Netflix, you'd actually be down about 4.9%, roughly, right? It changes daily. If you added Amazon to that, because of the heavily weighted of Amazon, this gives you a great example, the S&P would be down 8.6%. So just taking one more stock and removing it from the S&P would take the loss in the S&P from 4.9 to 8.6%. So, that gives you an idea of how just one or two stocks can make a huge difference of the S&P. And again, the takeaway could be that, hey, maybe the S&P isn't a good indicator of the entire overall U.S. market.
So, Dave, for our listeners today who are hearing this podcast, and myself as well, too, what does this all mean for us as the average investor?
Well, I would suggest there's two problems with the situation that we're in. And by problem, the situation I would suggest meaning this idea that you can look at the S&P and the assumption is that your portfolio should be performing the same way, or the situation of trying to reconcile how the market can be going up, where all other indicators of the economy seem to indicate that we are in dire straits. So two problems. First, I would say the S&P index gives a lot of investors, and we hear this all the time with our clients, the impression that American stocks are doing better than they actually are, but they're not doing that well. Like we talked about, over 60% of the S&P is not up for the year. The second takeaway is that exchange traded funds and mutual funds that are in the stock market and even in the U.S. stock market, and some of them specifically just track the S&P 500. It's one of the most popular investments for folks, especially if you've got a 401k or an IRA, and it's like the go-to investment is to put some in U.S. stocks. You'll pick a mutual fund, many people will, or an exchange-traded fund that just mirrors the S&P 500. So there's this huge volume of Americans, this mass of American retirees' money that is going into the S&P, reliant on the idea that it's an index that genuinely reflects the U.S. well-being. And so many folks are putting their money in the S&P 500 with the belief that they're very well diversified over the entire U.S. market, when the reality is they've got over a third of their money gambling in the high-flying tech stocks. So finally, I would suggest to consider that it's true that the S&P, the tech industry, and Amazon and the other Netflix, those kind of companies, have been a godsend to the S&P this year, right? So if you have been in those indexes that track the S&P, they've basically kept you from having huge losses this year, and that's wonderful so far, right? COVID has fast-forwarded a number of these tech trends, like online shopping, Jeff, or electronic payments, right, and things like that. They've caused some of these tech companies to skyrocket and take leaps ahead with the consumers because of the pandemic. But I don't know that that's going to last forever.
Yeah, these tech stocks are really zooming, Dave. I read where DocuSign is actually more valuable than Ford these days, so watch out for those tech stocks. We're talking about the stock market being near correction levels. Dave, let's stand back and take sort of the 30,000-foot view of all this. What is the takeaway from our conversation today, do you think, for the average investor?
Yeah, I apologize to you and the listeners. I can get a little long-winded. I love this information. My kids call me the math geek. But let's just, again, like you said, you couldn't have said it better. Let's go up 30,000 feet and look down. The podcast today, what are some of the takeaways? I would say first, just be aware that the S&P, even if it may have in the past, the S&P does not really represent the total U.S. stock market any longer. So just understand that when you're talking about the S&P, at least where we are now, 30 to 35% of that market right now is the high-flying tech market, as well as some of the big companies like Amazon and Netflix. The other takeaway is it doesn't necessarily and probably in any way represent your retirement account, even if it's invested in the market. So there's a reason why if the market's up 10% and your account, which you thought was invested in U.S. stocks, is only up 5%. Or it's just as possible that the market's up 10% and your account's up 12%. It's because you're not in the exact same things as the S&P. Now, with respect to tech stocks, here's the big takeaway. These trillion-dollar tech stocks nearly doubling in a half year, right, in 6 months, Jeff, it is not the norm. This is a big takeaway. It's not a norm by any stretch of the imagination, right? Chances are tech stocks are going to take a breather somewhere down the line, and when tech stocks that are making up 36 to 37% of the S&P start pulling back, they could also cause a drag to the entire S&P 500 as people start to panic and pull out. So my advice would be really dig into your portfolios and see how much risk you're taking in your portfolio, how much is in one sector, like the tech stocks. Don't just assume because you're in the S&P that you're well diversified, because if there is a one takeaway from today, that would be it, right? Just because you're in the S&P does not mean you're well diversified at this point.
So when Grandma sent you to town with all those eggs, your chickens laid, and you were going to market there, her best advice was, hey, don't put all the eggs in one basket. Put them in a couple of baskets. If you drop one of the baskets, at least the others will survive. Grandma had good advice, and it's still good today. So, Dave, we see things in the news about how dire things are, but yet the stock market goes up, it goes down. Why is there such a disconnect between the stock market and reality?
Well, one thing is you have to remember that the stock market is what we call forward-looking, which basically means people are betting. That's the easiest way to say it, right? They're betting on what they think the economy is going to look like next year or the year after that. So right now, a lot of people are betting on everything going right over the next 12 months, meaning we're going to get a vaccine for the virus and we're quickly going to all get vaccinated, and then everybody's going to go back to work and everything's going to go on a tear. Well, if any one of those things or combination of those things doesn't pan out, then you're going to see people making a different bet based on what they see the economy going on. So you could see it turning. So the takeaway is understand that people are speculating in the stock market, not on where a company is today, but where they think it's going to be over the next 12 months to 24 months based on economic events that are going on around the world. So everybody's got their own opinion on that. That's what makes the stock market work so well, right? For anybody who thinks it's time to sell Apple, there's somebody else who thinks it's now time to buy Apple. Now, when you see a stock market crash, that's when the overwhelming cumulative belief of the masses is that things are going to get worse and worse, and they're going to literally be worse tomorrow than they are today, so I've got to get out. So you have mass selling, and that starts the kind of correction that we saw in March of 2020. Likewise, what you're seeing today, where it seems like regardless of what's going on in the economy, the market goes up every day. That's the exact opposite of what we saw in March. And there's a name for it. It's called FOMO. Fear of missing out, where people are thinking, look, I know the market won't go up forever, but on the short term, I think it's going up. And as long as I can get out before the next guy, I'll make money over the short term. So everybody is really betting right now on just the market going up over the short term, right? And hoping they can get in, make another 5 or 10%, and then get out before it corrects. Everybody understands that the market will correct. And the only reason I say that confidently is never in history has the market always gone up forever. Am I right?
Absolutely. It goes. We had a big, long 10-year bull run like that, and then it's gone down.
Right. It goes up and down. So this is the fastest correction. So many would argue that it hasn't gone down at all, right? Within 6 months of that blip because of the pandemic, we're right back at all-time highs. So we're really running an 11-year high, which is the longest bull market in U.S. history. So again, and I know I'm a broken record on this, but if you look at the data and the facts, they suggest that never in history has the market gone up forever, right? It expands and contracts like an economy. It expands and contracts like your lungs. And the further the expansion, usually the further the contraction. So we are overdue for a correction. All we don't know, Jeff, is when's it going to happen? Is it going to happen this week? Is it going to happen next month or a year from now or longer? When's it going to happen? When it does happen, how severe? Is it going to be a 10% correction? Is it going to be a 36% like in March? Is it going to be 50 plus like in 08, right? Or 48 or 49 plus like in 2000? And then the next question is, once it corrects, if you just hung tight and didn't panic, how long before you get even? Is it going to be, 3 months like we just saw? Is it going to be 5 to 8 years? Or is it going to be longer? I mean, there's time periods where it took the market 20 years after the Great Depression to get even. So this idea that as long as you hold tight, you'll be even in 4 or 5 years, data suggests that that's not necessarily true after especially a big correction. So know the data, know the facts, and if you don't, get with someone who can walk you through them. I would propose that if you've accumulated any wealth over your lifetime, you're a bright person, right? It just doesn't happen by accident unless you won the lottery. So you can make the right decision if you have the data. And one of the things we are so proud of that we do at ILG Financial is we'll sit down like we're doing today in the podcast and lay out the data. Once you see how the stock markets performed over long periods of time, going back to, the 1900s, and you can see the different times the market's gone up and when it's gone down and how far it went down and how far it took to recover, you're going to very easily be able to make decisions on how you want to invest moving forward. But you need the data to make an educated decision that's in your best interest. That's my takeaway.
Well, I think our conversation today really illustrates the fact that at ILG Financial, you really do put in the work. You make the effort to understand all of this, and then consequently you can use that information and knowledge to help your clients get into the right sectors with their portfolios. Income, legacy, growth, it's all right here at ILG Financial, and it's about helping you plan for retirement your way so you can achieve your financial goals. So we invite our listeners today to call ILG Financial at 540-720-5656, or you can go online to ilgfinancial.com to learn more. Dave, it's been a pleasure talking to you on this podcast about the stock market and the possible correction. I invite our listeners to join us again next time when we'll be back with another edition of Retire Your Way. For Dave Lopez, I'm Jeff Shade. Thanks for listening. Have a great day.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial, LLC are independent entities.